Thanks for joining us today. Today is Tuesday, May 3rd. And we want to start out by talking about interest rates, and then we'll talk a little bit about the economic data and then finish off with earnings today. And again, we're continuing to see just the movement away from some of those pandemic related companies, those companies that did very well during the pandemic. So today we're going to be talking about Chegg, Clorox, and Pfizer. But we want to start off by talking about interest rates, because yesterday interest rates really rose significantly. What was interesting yesterday was that the curve kind of flattened again. And we're seeing interest rates come down just a little bit today. But Tom, I really wanted to camp out a little bit on the mortgage rate, because mortgage rates continue to rise and rise and rise. The bank rate 30-year mortgage is now at a 240 basis point spread over the 30-year treasury, which means that if for instance, the 30-year treasury is about 3%, a mortgage right now is about 5.4%. And the 20-year average of this spread is only about 100 basis points. So in a typical environment, you'd expect a mortgage rate more in line with about 4% rather than 5.4%. So mortgages are really just getting blown out right now. The peak was 280 basis points in 2008. So even when it was about as bad as it's ever been in terms of financial markets locking up, especially on mortgages, you are only about 40 basis points worse off than you are today. So we are a long way from normal on the mortgage side. And I'm just curious, when does this adjust? Because right now there are rising finances costs more generally, but in mortgages, they're especially rising in terms of the financing costs. And it's really limiting the ability for first-time home buyers to get a mortgage.
It's really tough to say, because we're not even really at the point yet where the Fed is actively selling mortgages. And that's, the way they do quantitative easing, they're actively buying mortgages in order to keep them artificially low. What we're going to see now is probably the opposite, which is they're going to start aggressively selling mortgages off the books. And I just don't know how much of an effect that's going to be. I mean, it's going to be, right now the estimate before they officially announce tomorrow is $35 billion a month, which is a lot of money, pushing up on the mortgage rates. And so my guess would be that it's less likely that the 30-year mortgage is going to fall and more likely that the 30-year treasury is going to rise. And so the spreads might tighten, but my guess would be that the 30-year mortgage or the 30-year treasury is going to be the functional portion of that, which essentially it's going to rise to meet it, because, they're also going to be selling $65 billion of mortgage backs or of treasuries as well. And so my guess would be, in order to make that a little bit more of a homeostasis, they're probably going to be attacking the long end, if I was to guess, and really trying to get that to a more of a normal level, or at least a sustainable level. But for the time being, I would not be really looking to get into mortgages, at least until we see some stability there, because we're just seeing it move up every single day. So if you bought mortgages last month thinking, I'm going to lock in at 4.5% on these mortgage-backed securities for 30 years, no one's going to ever refinance these, you're probably looking at that being down quite a bit already, because your duration on a new issue mortgage back is going to be 30 years. And that's, really not where you want to be in terms of maximum susceptibility to rising interest rates. And so you're losing principal value very quickly. So my guess would be 30-year treasuries rise and meet them. They're probably going to attack the long end in order to fight the flattening that we've seen. I mean, if you look across the treasury curve right now, the 3-year treasury is at a 295, the 5-year treasury is at 3%, 7 years at a 302, 10-year is right at a 3%, and then the 30-year is also right at 3%. So you basically get absolutely no incremental yield in terms of how far out you're going. So if you say, I can get 3% by going out 3 years and get my money back in 3 years and see where rate environment is, going out 30 years and locking in at 3% for 30 years is not a good deal. And so I think that needs to change. And I think the Fed is going to try to address that. But I mean, for right now, the spread between a 2-year and 5-year is probably where you see the most of a bend, 2 years at 275. So that, kind of 2 to 5 year range, I think is where you want to be on the curve right now. I think what you're doing is you're limiting your downside. And we've already seen such a massive move on the 2 year, and, not to get into deep bond math, but your convexity at that level is going to be significantly less. You don't want to be so far out of the curve that the more interest rates go up, the more you get banged up. And, the shorter you are, the less likely you are to have that happen. And so, that would be my guess, is that the Fed's going to attack the 30-year treasury less so than they're going to be really attacking mortgages. But, they've got to pick and choose where on their balance sheet they want to be selling, what's the best value, what's going to move the yield curve in the way that they want to. And they've got a lot of tools there. We just aren't privy to that information.
The trader in me thinks that we could be setting up for a pretty interesting asymmetric opportunity in mortgage-backed securities. And I don't think the time is right now, but we are getting pretty close to that time. And that is the opportunity. Right now, you have a massive spread with the 30-year. So as you point out, you don't really want to be buying 30 years right now when you can buy shorter and still get the same yield. But you could buy a mortgage-backed security with these new issued mortgages that are coming out at 5.25%, 5.5% on the mortgage-backed security. You're getting a spread to the 30-year. So you're insulated a little bit if interest rates rise, because as you say, the spread may compress. But then also if interest rates fall, that thing's going to come shooting down. And when that thing comes shooting down, that mortgage-backed security, you're going to see those rates go down very quickly. You're going to see refinancing come quickly, and those mortgages are going to start peeling off the board extremely quickly. You're going to get that principal back very quickly, much faster than expected. And that's where you want to be positioned for. So I would say, we're not there yet, but it's a place that I think is an increasing interest, and we're increasingly watching that area of the market as an area of opportunity. What's worth noting in the housing market is that we continue, even with the mortgage rates rising, there are actually a few factors that are arising that. Some of that is a little bit unintended consequences of the higher rates. Number one is that it's reducing mobility. So when you reduce mobility, not only do you reduce the number of homes purchased, but you also reduce the number of homes available for sale, which shrinks supply. When you have lower supply, you have higher prices. And what we're seeing is the people who are buying the homes are the cash buyers, so the people who are well financed. So we're ending up seeing the wealth gravitate more toward the wealthy. And that's what happens in an inflationary environment. These higher mortgage rates are probably, people say we want lower mortgage rates to help the first-time home buyer, and that's probably true. These higher rates are really more advantageous to the well-financed buyer, the real estate investment company, the large cash buyer. Right now, sale to list prices are still well above 100%. They're continuing to rise. They're 102% right now. So if you see a home, just a regular home in the United States listed for $500,000, you can expect that home is going to sell for $510,000. Shifting gears a little bit to manufacturing and the ISM data that we got yesterday morning at 10 a.m. We're seeing what you would expect in a recessionary environment, in a economic contraction. You saw the headline number decline from 57.1 to 55.4. You saw new orders decline from 53.8 to 53.5. Employment declined from 56.3 to 50.9. And a lot of this was attributed to slower month-over-month growth due to extended lead times and high material price increases, as well as consumption softening due to labor force constraints. Overseas partners are experiencing COVID-19 impacts, and there's a near-term headwind for the U.S. manufacturing community. Big picture is the economy, especially on the manufacturing side, is beginning to taper off a bit. We already knew this. We knew this in Q1. GDP was down, but this is more confirmation data. What's interesting, Tom, here is that prices also fell month over month. They decelerated month over month, still rising, but at a slower rate. There were 87.1 in March, 84.6 here in April. So again, still an elevated number, but coming down from those lofty levels, which suggests that maybe Powell is actually achieving what he wants to achieve without even having to do anything right now. He's seeing a demand contract. He's seeing prices begin to decelerate. And maybe that in the latter half of this year works to his advantage, because then he can take his foot off the brake just a little bit. Because right now he's stomping hard on the brake. he can take that off a little bit so we don't go crashing through the windshield.
Yeah, I would agree with that. I think that we're starting to see the effects of either the narrative that rates are rising or that they're actually rising. And I think that we're seeing a slowdown. I mean, with the housing thing, I mean, it's just who's going to be a new home buyer if the average cost of a house is 400 grand in the city of Atlanta, and you know, are looking at paying $4,000 or $5,000 a month to live in a house that's, 1,400 square feet in East Atlanta. It's just not a sustainable thing. There used to be pockets where there's affordable housing. You might be taking on a little bit of crime risk, at least in my case, in my first house. But, I just don't think that's there. I don't think there are pockets of opportunity for young home buyers. And I think that slows things significantly. Obviously, prices coming down is a good thing, which shows that, there's a lot of demand being sucked out of the market, and where it's flowing is into, food and gas and trying to buy a house. And those things are pulling away from ancillary items like, we saw Nike absolutely crush it after the stimulus checks come out. I don't think there's anybody that's going out and just buying extra Air Force Ones right now, given the landscape, given the sentiment that everyone's feeling. You might need that money for a tank of gas in the future. You shouldn't be buying shoes. So I think that's something we really need to be cognizant of. And I think that the effects of Powell's signaling is definitely being filtered through the market. But, right now, looking at the interest rate futures, we're looking at 11 total hikes right now for the year. I would still continue to take the under on that. I think they'll be very aggressive on the front end. I think we'll get probably 5 hikes in the next 2 months. But after that, I would say all bets are off. I don't think that we're going to need 11 hikes this year. But, I think it's tough to say because they were so late getting into the game on this that, the effects are very difficult to suss out.
We're continuing to see higher inflation at some materials producers. Martin Marietta, the large aggregates producer, they reported earnings this morning. They didn't change their volume guidance at all, still see 1% to 4% growth for the year on an organic basis, but they did increase their pricing. Their pricing went from 5% to 8% to 9% to 11%, and that's a full year number. So basically going from a midpoint of 6.5% to a midpoint of 10% in a single quarter in terms of your estimate of pricing. That's an extreme move, and they're really pushing pricing very strongly. In fact, they actually reiterated their earnings guidance, their net earnings guidance, despite selling a business. So even though they sold a business, they're still going to be able to hit their earnings number because solely of that pricing piece. Elsewhere in the earnings front, we are seeing, again, the pandemic winners beginning to cool off significantly. Chegg, which operates an online tutoring business, textbook rentals, etc., they were down 38% overnight on the heels of weak earnings. They're down 86% over the last year. They cut revenue guidance. And I just thought management sounded tone deaf. I wasn't going to review this quarter. We don't have a vested interest in it. We don't have positions in it. It's a relatively small company, but when the stock's down 38%, I have a morbid curiosity to read the transcript. And they sounded completely tone deaf. They said, we had a solid first quarter, and Chegg is executing well against our strategic objectives despite continued industry headwinds. These are people who haven't had a tough period in a macroeconomic sense. These are leaders who have not gone through this before, and they are not handling it well. They claim to continue to operate their business. They can claim to be continuing to operate their strategy, but they lack the experience to manage a dynamic environment. And we're seeing that from some of these companies. Chegg is a poster child of that. They say that the issues of enrollment, the economy, and inflation have all impacted our industry. Say, well, how's it impacting the education industry? And they say that people aren't going to school anymore because the wages are doubling out in the marketplace. I think that's an extreme characterization, but I'm sure that is impacting their business. But I think the bigger impact of their business is, frankly, that people are just doing less online now than they were last year. Clorox is another pandemic winner that's struggling. They were down 2% on earnings. This one was mainly resulting of costs, higher cost inputs. They will be inputting more price increases in the back half of the year to offset that. Pfizer, it's down 1% pre-market. What's interesting with Pfizer is that they had extremely strong COVID revenues in this quarter, The rest of the business did not perform well. So to give you an idea of the scale, for Pfizer, $15.7 billion of the $26 billion that it made. So 60% of their business was COVID related this quarter. And they reiterated all their COVID revenue related guidance. I think there's no way they hit that guidance number. They're saying that their Paxlovid, which is their therapeutic for COVID, is going to be $22 billion in revenue this year. Well, it was $1.5 billion in Q1. Now, part of that's the manufacturing ramp. Part of that's getting healthcare providers to prescribe Paxlovid. I just don't think there's any way they hit that. They have a bit of an out because they can then blame reneged contracts. But that one was mind-boggling to me. It'll be interesting to see how that trades throughout the day. And then finally, tonight, you have Starbucks coming out with earnings. There's been a big union push there. You have a new CEO, Howard Schultz, who's back for his third term as CEO to be the savior. His first month in charge has not gone well. A lot of big union push there. Big issues in China with the shutdowns. So that'll be an interesting conference call tonight. Tom, any thoughts on these stocks?
I mean, I think that the new normal has just ceased to exist. I think everyone thought we are going one way and it's just kind of evaporated. I think the canary in the coal mine is probably Peloton, really struggling coming out of the pandemic. Teladoc, Chegg, Pfizer. This is sort of anecdotal, but my grandma, who is 92 years old, in February moved into an old folks home in Buckhead. And I had felt bad because I had sort of avoided going to see her because I was worried it was just going to be lockdown city, all kinds of, hurdles to jump through to get in to see her. But I went and saw her on Sunday, and I was concerned because Molly, being a child, doesn't have any sort of, option for vaccine or anything. And they didn't seem to care even a little bit. I called up the front desk. Was like, hey, I'd like to bring my daughter to come by and see my grandma. And they were just like, yeah, cool, whatever. And there wasn't any sort of, show me your papers, that stuff. They took your temperature. They asked you if you had a cough, and that was it. To enter a facility full of, octogenarians and old ladies. So I think that's a real read through. And then I also read an article over the weekend that there's been, millions and millions of units of Paxlovid shipped. But the article was interviewing a sort of mom and pop pharmacist. And they're saying that they've just got shelves of it, and they've had maybe 6 people have it prescribed to them over the last couple of months. And they're just like, we're just drowning in this stuff. We have nowhere to put it. We thought we are going to get so many orders for people getting on these, antivirals when they got COVID, but there seems to be almost zero demand for it. And I think that is a really bad read through for Pfizer. I think they are trying to avoid getting smashed today by not changing their guidance on COVID stuff. But obviously we've said this many times over the last 2 years, but I think COVID is kind of officially over. And I think that Pfizer is not going to have the revenue going forward that they've had over the last couple of years. They're in a great position. I think the stock's undervalued. They got plenty of cash, but they've got to use that cash to turn and pivot and go somewhere else because this is sort of a dying industry.
Yep. I think I would agree. So with that, we'll leave it there. We'll see you tomorrow, May the 4th. Tomorrow, so Star Wars Day. So we'll be on that. Maybe we can even get some tunes going. I don't know, but we'll see what happens with that, and we'll see what happens with Starbucks tonight. We'll see you tomorrow.